Hey everybody, welcome back to another financial slash economic collapse report. Yes, we are in an economic collapse. It's just a very slow motion collapse. We know that the rate increases with the interest rates and the Fed funds rate has been very methodical and incremental because of so much debt in the system right now. But with the higher rates, the debt markets are really starting to show signs of stress. In fact, we had another surge here in the 10-year bond yield. What does that mean? That means they're having to raise the yields in order to attract buyers, in order to attract a buyer of this debt. And the Fed is no longer there like they once were. Now, we did see a bounce back in the spring. The housing market took a bounce. And what happened back then? Well, the Fed came in with, was it 400 billion in liquidity when the banks started failing. Remember that? And the balance sheet actually went up a lot, about 400 billion. But since then, we've been declining. We're down to about $8 trillion on the Fed balance sheet. So the buyer and lender of last resort is pulling away from this market. But let's talk about what happened with the bond yield today. So mortgage rates are going to be going up higher once again. But just in the past couple of days, we saw the 10-year bond, the 10-year treasury, reach 4.8%. And that's the highest that it's been. We'd have to go all the way back to early 2007. But there's no signs that this is going to stop anytime soon because inflation, the war against inflation, is not being won. In fact, it's a losing battle right now. Of course, the powers that be are not going to admit that. They're going to say they're winning. That way, if they have to do emergency rate cuts, they'll feel justified in doing so because they told you and they told everyone, oh, look, we're winning the fight against inflation. Prices are coming down, which prices are not coming down. In fact, prices are going up. They're just going up less fast or less quickly. So they're saying that that is actually a victory when actually it's not, because the inflation target is 2%, and we're nowhere near the 2% inflation target. But yet they're telling you and me and the world that they're winning the fight against inflation when they're really not. The problem is if they cut rates, then the cost of living is going to skyrocket even more, and all the poverty, all the damage, all the destruction that we've seen is just going to multiply, and it's going to get a lot crazier here. So let's get into the news here. I got a lot of reporting I want to get caught up on here today. Speaking of inflation, let's talk about hyperinflation and what's happening over in Argentina. Argentina, one of the countries with some of the worst inflation. The CPI in August of this year alone was 124%. Wow. But yet, listen to this. You're not going to believe this. The president there over in Argentina said, or one of the candidates, I should say, said he wants a central bank digital currency to be implemented to solve hyperinflation. You believe this? That's how they're going to try to push this digital currency on people, the central bank digital currency. Does anyone think that a currency in completely digital form, with all the controls and mechanisms built into it, is going to solve hyperinflation? They're going to be able to flood the economy, flood the system with money even faster now with this digital currency. It's amazing how people are actually falling for this, though. That's pretty shocking, but that's what you're going to be hearing, I think. You're going to say, they're going to say, and you're going to hear, well, we need to implement this as a solution because when prices get higher and higher, when we look into next year, the middle of next year, when prices are even higher than they are now, and when household bankruptcies start skyrocketing, and when foreclosures start picking up pace, and when credit card defaults, car loan defaults, all these things, people getting their utilities shut off, when all these things start happening to an even greater magnitude, they're all happening right now. They're just still kind of low for now. We're still in the beginning stages. But next year, when these things start accelerating and they're going to be forced to report it on even the business news networks, then that's going to be one of the talking points. Oh, we need to implement this digital currency. This way we can control the money better, and it's going to help with the cost of living, when actually it's going to be just the opposite. It's going to make it much, much worse. And there's a lot of other nightmares that come along with that type of currency that we've talked about here before, but I'll skip that for now because I want to get into some other news here today. Let's talk about what's happening in San Francisco. We know that the cost of living crisis has really made homelessness jump. And you see it more noticeably in certain cities, especially the warmer cities out here in California, where a lot of homeless people like to migrate to. Obviously, do you want to be homeless in Minnesota or Southern California? In this case, not Southern California, but San Francisco. Starbucks closing down 7 downtown stores. So San Francisco continuing to implode. And we told you right here on this channel over 3 years ago that we're going to start seeing homelessness get worse and worse and worse. People said I was crazy, that no, I'm a doom and gloomer. And here we are. Every time we look at the news, we've got more just amazing news on what's happening with homelessness, the crime, the poverty, the despotism when people trying to take things without paying for them. A lot of these people, they just don't have the money. But speaking of inflation and the cost of living, the U.S. dollar not dying anytime soon. Remember, we talked about the BRICS countries coming out, and I said they're likely not going to announce a gold-backed currency. If they would, then that would have been really caused a noticeable drop in the dollar. But they didn't do that. What they talked about was more countries coming on board, trading outside of the dollar, things like that. But we see the dollar is actually still very, very strong. It actually reached 106 today. How long is this going to last, though? How long is this going to last with the tightening the Fed's doing with the interest rate increases? That is really helping the dollar remain strong for now. But does anyone here think they're not going to do emergency quantitative easing? The Fed comes in and starts buying bad loans as people start defaulting. Does anyone think that they're not going to do emergency rate cuts all the way down to zero and who knows, maybe negative this time? Because remember last time, over the last 10 years, we were near zero. So now this rescue effort has to be even bigger than the last one, just like the last one was bigger than the one before. They always get bigger. You notice that. So the next one could be zero and maybe negative interest rates. That's what I'm afraid of. And the announcement of this digital currency, we've got some big things to try to be aware of here headed down the road. Now, of course, in the meantime, don't go hide in the corner. You still want to try to prepare for this, invest where you can, still have cash, because if you see this deflation hit and you see falling asset prices, real estate, automobiles, whatever it is, you're going to want to have cash to be able to scoop this stuff up, right? And I've said that for years. I said the dollar's not going to die just like that. It's going to be a slow motion process, the same as this slow motion economic collapse. Let's talk about the continued implosion in the labor force here with more layoffs and strikes here, strikes causing layoffs. Also, we're going to talk about that here in a minute. First of all, Citigroup outlines layoffs process. So they haven't announced the number yet. We're going to keep an eye on it here for you. But they're out there talking about how they're going to incrementally realign the company with business needs. And they talked about cutting some of the force there. So we're going to talk about the numbers here in a future report. Ford and GM laying off 500 employees amid the UAW strike. Wow. So there's a lot of people that are not striking, that are actually still wanting to keep their jobs. And they're going to get laid off because the production has slowed down. So you have office people and other people that actually aren't on the picket lines that are losing their job because of the other people that are striking, right? So even though they didn't cause it, a lot of them are feeling the effects. And remember, it was only 1 or 2 reports ago we talked about how Wells Fargo is cutting another 500 employees out of their workforce. Some of them in the mortgage division. The mortgage division is just bleeding right now, even though home prices haven't really crashed yet. I don't think they're going to crash, but home prices haven't really corrected that much. The low volume in the mortgage industry and in real estate sales, just the low number of sales and the low volume is causing massive carnage and just not as many people needed. We have, 2 million people with real estate licenses, real estate agents, and we're going to see that number drop probably down to 1 million or less here before this is done. Now, if the powers that be come in and cut rates sooner than expected, you might not see a very big housing correction at all. And even the people buying homes today at these prices, they're going to seem like geniuses if there are emergency rate cuts and when prices start going back up. I think there's going to be emergency rate cuts. The question is how much asset deflation or how much falling prices, what will be the magnitude of the falling prices that we see happen before the emergency rate cuts are implemented, right? So remember in 2008, home prices never had a chance to fully correct. They never went back down to the mean, and the mean would be the long-term price trend, right? We see it spiked up and came down, but the long-term trend, it never actually hit that bottom because the Fed came in so heavy-handed with the bailouts, with all of the guaranteed backing of the too big to fail mega banks, and the rest is history. And we saw rock bottom interest rates for a decade plus, and here we are now with home prices way above where they were back then. So we're going to keep an eye on that. The mortgage layoffs continue to worsen, just as we said would happen. Here's another one that really it really caught my eye. Janet Yellen, Treasury Secretary, is out there. She said this. Listen to this. Surprisingly resilient American consumers blocked a recession. We know that consumer spending is the backbone of the economy. But she used the word resilient when we know that people, in order to spend, they're running up credit card debt like never before. But according to her, that is resilient, right? So people taking on a lot of debt, that's resilient. Of course, she's going to say that because they want to encourage people to take on debt. That way they can look and say, hey, look at all this economic activity. Look at the GDP growth. Look at all the spending. People must be, doing very well financially. When really a lot of the spending is buying things that cost too much and having to buy them on a credit card and therefore going to deeper debt. So that's her idea of resilient. And she also went on to say this too. After that, she said, and now the Fed could keep interest rates higher for longer. So because the consumer is resilient, in her words, now we can keep rates higher for longer. So this is going to be, a struggle with all the debt, with the high rates, and when something breaks, I think the debt markets are going to implode at some point because we have the banks out there with all these underwater assets, their loans that they gave out at 3%. Now they won't be able to unload those because who's going to want to loan a bundle yielding 3% when now there's much higher rates, right? So it looks like the banks weren't prepared for higher rates. We haven't really seen the carnage of it yet. We're yet to see that. And it could happen anytime. It could happen next week. It still might take a few months to play out here. It still might take a year to play out, right? So the timelines are very difficult to forecast or predict when you have a manipulated market, right? When you have a force that could just come in and buy up all the debt, that makes forecasting very, very difficult, right? So that's why you see all these different price predictions and people over here saying prices are going to collapse. Other people over here saying prices are going to continue to rise for homes and everything else, right? So pretty crazy times to try to navigate here, that's for sure. What else is happening? Well, debt forgiveness is happening. About $9 billion in debt is being forgiven for about 125,000 Americans. Now, think about this here. That's a very small number because we know that student loan debt is what, 1.8 trillion approximately. So 9 billion is just a scratch on that. And 125,000 Americans, we know that the number of Americans that have student loan debt is over 40 million, right? 40 million people with student loan debt. So this 125,000 people that are going to get 9 billion collectively forgiven, again, it's just a fraction, just a scratch of the overall figure. But it's interesting how, some people get, these benefits, or some people get help when other people don't, right? It's supposed to be fair and things are supposed to be even, but we don't see that. We see some people getting help. Just like in the business world, some businesses, they get propped up no matter what. They get rescued no matter what. Also, mortgage rates racing towards 8%. The average 30-year fixed mortgage hit 7.2%. 7.72%, sorry, according to Mortgage News Daily. And the way things are looking, I think they're going to hit 8%, maybe even 10%. And, what's it going to take to cause a big correction in the housing market? How much longer can homeowners that are not selling right now, how much longer can they keep up with all these costs before they have to put their home on the market? The problem is, it used to be you could sell your home and then go rent somewhere. A lot of people sell their home and then move up to a bigger house or use their equity to, trade up to something else. But a lot of people also want to just keep the cash and then go rent or move to someplace that's cheaper, and just hold on to the cash, right? There's a lot of home sellers that want to do that. The thing about it is now, though, if you sell a home, good luck finding a place to rent that's cheaper because the rent bubble is pretty crazy right now as well. That's actually coming down, though. We're going to talk about that in our next report. Rents are correcting. In fact, rents are now negative year over year. And that's a trend that we haven't seen, or that's something that we haven't witnessed since I think 2019. We'll get into that on another report here. We've got some other news that I really wanted to get into here today. Kaiser Permanente, a medical provider out here in California. I'm not sure how many states. I think they're in a lot of states anyways. The number of people on strike is 75,000 at hundreds of different Kaiser locations. Why are so many strikes happening? Because the cost of living, people cannot get by, and they're demanding higher wages. Folks, there's a lot of things happening behind the scenes, so to speak, in the financial industry that it's not even being reported. I can tell you that there's so much debt out there with these derivatives. We're talking trillions upon trillions. It's in the quadrillions. The numbers are so large that it's even hard to wrap your head around, right? Somebody said that if you stacked all the debt in dollar bills on top of dollar bills, that it would go to the moon and beyond. That's how much debt there is out there. No one's going to be able to prove that, obviously, but it is interesting thinking about stacking paper to the moon. It's just how much debt is out there. It's probably even beyond that. Who knows what planet is it going to reach if you stack it on top? It's impossible to stack it because it's not even real money. It's not paper money anymore, which even paper money is not real money, but it's mostly digital. So they want to go completely digital. They want to be able to flood the economy even faster with this digital money. They want to control what people spend their money on, how soon they have to spend their money, where you can donate it to, lots of other things they want to implement. So it could get pretty nightmarish here. Hopefully it won't last long, though. Hopefully the collapse will be fast and hard. People will wake up and demand sound money. My fear is that it could be a prolonged downturn, a prolonged Great Depression 2.0, and if it drags out a long time, that's really going to cause the most damage. We don't want to see that. We want to see a fast, quick correction. Of course, they raise rates very slowly, so they're making this economic downturn happen, much slower than I would like. But to other people, this is more time to prepare, more time to get ready for what's happening. So everybody, we're going to wrap it up here. Continue to look for investment opportunities. Continue to prepare. 30 days essentials out of the system, money out of the bank, cash, food, water, essentials, right? So we always want to be prepared for the big one. We wake up and something broke. We know in the past the Fed, they raise rates until something breaks. Whatever breaks this time and whatever comes crashing down from that break could be much bigger and much more fierce than we've ever seen before, right? So always keep stacking, everybody. As always, big love. Bye for now, everybody. Peace.